Hi folks, welcome back to our third video on our problem here that deals with intercompany land sales, intercompany dividends, and intercompany inventory sales. So now we're going to complete the B part. I know you probably found the A part exhausting, going through the statement of changes in equity that's consolidated, but there were a lot of little pieces we needed to calculate. So hopefully listening to the video makes you feel a little bit more comfortable with that. Now we're going to do the B part, which is looking at the consolidated balance sheet. So you know that consolidation is pretty much an additive process. We take the assets of the parent and add to them the assets of the sub in order to come up with a consolidated balance. In this case, for cash, we have $500,000 of the parent, $40,000 of the sub. Receivables, $1.7 million in the parent, $500,000 in the sub. Now this amount here is probably not ideally where to put it, but you'll remember there was an intercompany dividend that the subleased declared, and $80,000 of that $100,000 dividend that was declared would go to the parent company most. Well, because they didn't create a dividends receivable or a dividends payable account, they've just lumped them in with accounts receivable and accounts payable. So this would be the dividend that the parent would be waiting to receive from the sub, but again, because it's intercompany, it would have to come out. So they're assuming that this $800,000 or this $80,000 is in with this $1.7 million. With the inventory now, we take the inventory of the parent plus the sub, and we're going to take out the ending or the profit in the ending inventory. So where is that? Again, we'll have to go back up to our intercompany profit analysis, which we did way back when, and you can see it's here. It's in the inventory, right? Ending inventory, the total of most and least selling. So the total amount of profit that's sitting in ending inventory for ending inventory items that again have not yet been sold by the end of year 9 is $314,284. So therefore, if we come back down here, that's going to impact our balance sheet right here. All right, so we come up with this number. Our plant and equipment at net is going to take the plant and equipment at net of the parent plus the sub, and then that is the unamortized acquisition differential. Again, if you go back to your schedule that you did right at the very beginning right here, that's this little fella here. Okay, so now if we go back down here, we also have the land, again that of the parent plus the sub. Goodwill, again, if you go back up to your schedule of amortization or schedule of acquisition differential amortization and impairment losses, again you'll see that the recoverable amount of goodwill, that's what's going to go on the consolidated balance sheet. And I think I made a mistake before. I think I referred you to this number in the consolidated balance sheet for the plant and equipment at net. I really meant this one, because anything that's in this column here, this last column, this balance at December 31st, year 9, that's going to show up in the consolidated balance sheet because those are the ones that are unamortized. So now we know that going down here, we're also going to have deferred taxes. Remember, we said before on any of the amounts of ending inventory that's here, the ending inventory, that's the profit, but don't forget the entities that book that profit have already paid tax on it. So the consolidated entity views it as prepaid taxes. And this is the total amount of the prepaid tax that we would have seen on the items that make up this number. So if you add it all together, you're going to get total assets of $19,509,905. And again, if we look at the liabilities and equity, we're going to have the current liabilities of the parent and the sub. And again, this would represent the amount of the dividend that the sub has in here with its liabilities. It really isn't. It's a current liability, that's fine, but it should probably say here current receivables instead of accounts receivable, but they didn't. But in any case, it's the same kind of concept. This would really represent some kind of a liability, right? Which is sitting in this amount for the sub. Long-term liabilities on each most and least books is the same. Common shares, again, are only those of the parent because at acquisition we eliminate that of the common shares of the sub company, not literally, just figuratively, because again, we're doing the consolidated statements for the benefit of the parent shareholders and its interested and the other interested parties in the parent. So they only want to see the common shares, the value of those shares outstanding to the shareholders of the parent. So we only pick up the parent's common share balance. Retained earnings we calculated when we did the consolidated statement of changes in equity, and the NCI we already calculated two ways, and that gives us our ending balance of liabilities and equities, which is the same as total assets, so we're good. Right? Now, I'm not going to go through parts C and D. I'm not as interested in those, but I am going to go through because I do find from time to time students do calculate the ending balance of consolidated retained earnings as opposed to going through it this way to come up with it at the end by going through the opening balance of consolidated retained earnings, adding in the parent's share of adjusted income of the sub, its share of that, plus its own adjusted income, and deducting the dividends declared to its shareholders to come up with this. The other way you could do it is by starting with the ending balances of retained earnings for the parent most, and then for the sub least, and adjusting it. Well, first of all, we know that in this ending balance, there is the profit and ending inventory. And again, this is an after-tax amount. If you go back up here, you'll remember where we did that schedule right here. Ending inventory, most selling. So most would have included this in its ending balance of retained earnings at the end of year 9. But we know because that 500,000 in inventory that's sitting with leased, this amount here has not yet been sold outside, we need to eliminate that 60,000 in intercompany profit. Okay, so now if we go down here, we'll see that, where am I here? Yeah, we eliminated here. So now we have 10,340,000. Similarly to this amount, we're going to add the adjusted post-acquisition retained earnings of the sub. So if we go to the retained earnings of the sub at the end of year 9, we get it from its statements, but we don't want to include anything of that 2.3 million that was retained earnings that the sub earned before we became related, so we deduct it, and we get 1.3 million. This was given to you in the question, this 1 million. It said at acquisition, that was the retained earnings of the sub. We don't want that because they didn't earn that when they were related to us. This is the amount of earnings, cumulative, that the sub has earned while they were related to us. But in there is profit and ending inventory. And again, we saw that. If we go to ending inventory leased selling, it's right here, right? So now, if we go back down here, we also have to remember to deduct the cumulative acquisition differential amortizations, which is from years 3 to 8. And this is year 9 independently, so total to the end of year 9 is this. So we get our adjusted increase of 1,049,905. But again, we only want to take our share of it because we're doing consolidated retained earnings for the parent company shareholders. So we only want our share as the parent, and that's 839,924 added to this guy here is going to give you that 11,179,924 that we got when we did the consolidated statement of changes in equity. The other thing you can do is you can validate this number as well. So we did it this way, starting with the opening balance of NCI consolidated, adding in the parent or the sub share of the adjusted income of the sub, and the NCI share of the adjusted income of the sub, and then deducting the dividends that were declared to the NCI shareholders to come up with the ending balance of NCI. But you could do it the other way. You could start with the NCI balance, again, using either methods 1 or 2, In this case, I'll start with method 1. Look at the retained earnings and the common shares of leased at the end of the year. That's the end of year 9, which is 2.8 million. And we know that in this retained earnings, now we want to go back to that intercompany profit analysis and deduct from this whatever's in this retained earnings of the sub that shouldn't be there for consolidation purposes. Separate entity, everybody's fine, but consolidated wise, they may not be. And that's the profit that's in the ending inventory. Don't forget, that's profit sitting in the ending inventory of leased, right? Or the ending inventory of most, because most hasn't sold it outside. That was what leased sold to most. That's the profit on it. So leased has booked it. It's sitting in most's inventory, and that's the amount of after-tax profit sitting in that inventory. It needs to be eliminated because at the end of year 9 it hasn't yet been sold. So we deduct this amount from the 2.8 million to get 2,671,430, and don't forget we have to add in the unamortized acquisition differential at the end of year 9, and you'll remember that includes your plant and equipment at net, the unamortized amount of 4375, and your 374,100, which was your recoverable amount of goodwill at the end of year 9. So together that's going to give you 3,049,905. But don't forget, we only want to allocate NCI its share, which is 20%, which gives you 609,981. The other way we could calculate the ending balance of NCI is to start again with the balance at the beginning of the year and then allocate NCI its share of the post-acquisition adjusted retained earnings of the sub. And this 1,049,905 is what we calculated right up here. This is the post-acquisition retained earnings calculation. That's the number we get, this 1,049,905. But this is how we get it. We start with the retained earnings of lease the sub, adjust it for post-acquisition. So post-acquisition retained earnings is 1.3 million. Adjusted, we're going to adjust it by deducting our profit and ending inventory and our acquisition differential that's been amortized. So we're going to come up with this guy. 80% went to the parent, right? Because it's the majority shareholder, but the other 20% goes to NCI. So we adjust it down here. 20% of this guy is 209,981 added to the 400,000, and we get 609,981, which is exactly what we had up here. So we did it this way here because we were told to do a statement of changes in equity for the year. So we had to do it, right? So we had to calculate the opening balance and what happened in the middle of the year to come up with the ending balance. But if you were just asked to do a consolidated balance sheet, these are alternatives for you. You could do the ending balance of retained earnings this way, and you could do the ending balance of NCI either using this method or the second method. And that concludes our video on this problem. And so we do have 3 videos for this problem, and I hope you find it helpful as part of your review of the chapter.